Hi there, everyone, and welcome to this month's edition of On Track. It's the 30th of October as I record this. All our performance numbers are to the end of September, and all our news and charts are right up to the recording date. I'll dive in shortly, but firstly, as always, just our general advice warning. This monthly production is for the clients of McGregor Wealth Management, and in particularly those who use our care investment portfolios and process. For everyone else, please feel free to listen, but please don't act on anything unless you seek advice that's specific to your own circumstances. I'm going to go through all the usual stuff today, the market updates, the portfolio returns. Our single issue obsession at the moment is still inflation interest rates. I'm going to dive deeper into that again. We'll talk about what's happening with property and share markets. And as usual, try and put everything in perspective. And let me get into the news. And as I said, it's all interest rates, higher for longer, etc. It's interesting. So we're seeing that inflation is a bit stubborn. You'll see in the chart down the bottom, the US dropped, then it's up a bit. In the US at 3.7, it's not crazy. They, like us, try and have it in the band of 2 to 3%. So it's just above it. Australia, we dropped in the last 2 months. It's bounced up a bit. There's more in the 5 to 6% band. That's a bit more of an issue than it is in the US. And I saw a good article on the weekend that talked about how, Australia's pretty much got to claim this as its own problem now, not just a global problem. There are issues that we're going to have to tackle. It may mean, we get some cash rate increases, which will flow into mortgage rises. So not great news for mortgage holders if that eventuates. It's still an if. I'll talk about the chances of that shortly. 10-year bond yields are up. You'll see if we scan down the numbers. So the RBA cash rate was unchanged last month at 4.1%. They will make a decision on Cup Day, so next Tuesday. The market's at about 50-50. So 50% of the market thinks that's going up. That's the highest. The market has predicted it for quite a while now. 90-day bank bills consistently in that low fours, 4.15 at the moment. 10-year government bond yields are up, 4.53 at the end of the month. They're a bit higher than that now. Aussie US around about 0.63, and it's the lowest it's been for a while. Aussie CPI, as I said, 5.6, US inflation 3.7. Mortgage rates, the lowest you can find if you really hunt around is about 5.69 out of the majors. Macquarie is the best at about 5.89, and you can get 4.8% on a term deposit. The biggest news for the month outside of the financial world was the Israel-Hamas conflict in the Gaza. And as we speak, it's sort of spreading. What always happens around something like this is it increases global tensions. There's a lot of debate about both sides, the actions, the reactions, the overreactions, and you'll see it dominate the news for the next little while, I imagine. Conflicts like this rarely have much long-term effect on the share market, but they always create some short-term tension, and we've seen that with weaker share prices over the last month. Part of the worry amongst all the humanitarian worries on a conflict there is that it somehow affects oil and oil prices, and that can have a spillover, or that the conflict increases and becomes more of a regional issue. It's early days. I don't pretend to be a geopolitical expert. We watch this stuff as always, but usually the pattern on these types of wars, including the Russia-Ukraine one, was market has an initial drop and then it resumes its normal pace based on everything else. I've still got some slowdown concerns in China. So let's keep going. Portfolio returns to the end of September. The 1-year numbers were looking good here, but I should point out that they're different in October. October's come down some more with the potential for interest rates to rise a little bit more, probably before they're finished. So we've seen some weakness, but good 1-year numbers, 3-year numbers, and 3-year numbers good as well, all the way through. And we're looking at the 7-year numbers down the bottom there. Sort of in line with long-term assumptions. And keep in mind, inflation has averaged about 1% for the last 7 years. It's only been the last year that it's bumped up. So we've had a low inflation environment. So we expect those to increase over time. But the portfolio is doing okay. September was a negative month. It's looking like, barring a miracle, October will be a negative month as well. We've lowered our dial down to just under fair, so starting to get into the cheap range. We think it's a very good time to be getting into the market. It's at the low point for the year, and that means you'd be averaging at a low point. So yeah, for most of our clients that have got new cash, we're very comfortable with it going into the money at the moment, which keep in mind is always the opposite of what it feels like. Whenever we're saying the market's down, it feels like maybe that's a chance to get out, or maybe we should get out because there's uncertainty, but it's always the wrong thing to do in the long run. But that's what it feels like in the short run. We'll touch on more of that. I brought back our bad news, good news cycle, and part of that is seeing what news is around, and I'll just get these up. Not much has changed for the overall year. The hot new topics for the month were rates, potentially just being a bit higher. Let me put it into context. Yeah, a year ago, we were thinking inflation might be around for a little while. It's come down pretty quickly, but now it's just stuck stubbornly above that range, a little bit in the US, a little bit more in Australia, but still, 5-ish% when you look through, when the RBA looks through a lot of things, it's stuck around 5%. So it's not comparable to the 70s where inflation was double digits and higher, but it is a worry, and the RBA and most reserve banks around the world are on record as saying they want to get it back in to that range. So that's why the market's indicating that it's likely to go up a little bit more before it's done. So what eventually happens is it does its work, the economy slows down, and I'll go through some stats that we'll talk about whether things have slowed down or not shortly. But things haven't really slowed down. We've still got unemployment rates in the 3s. It's kind of crazy. And it's crazy that we can have such good news that is bad news. So, and this is why I brought back the good news, bad news. So in a time like this, which is a turning point in the business cycle, any headline good news like low unemployment, good economic growth, all these things are good news, but they're also bad news because it means the likelihood of interest rates going up. And the same with bad news. We've got the opposite. If unemployment goes up, that's bad news, particularly for those that are unemployed, but it's actually good news for this point in the cycle because it means we're getting to the end of the RBA doing its work. And the thing to remember with the good news, bad news cycle as well is that it's only news that's a surprise that affects the market. If the news is expected, markets don't change much. So if we've got a big surprise and it's good news, the markets go up a lot. Now, that can be news that is less bad. So if all of a sudden we're expecting inflation to be stuck now till the end of, they're talking about into 2025 now, but all of a sudden it drops quickly. So yeah, it might, the news, let's say it dropped from 5 to 4%. 4% is still high, so that could be bad, but it's less bad, which is actually good, just to use a bit of opposite language. So that would cause the markets to go up. And the same with news that can appear to be good. If it's not as good as we thought, that can cause markets to go down. Or if it's completely expected, then markets stay sideways. So whenever you see a headline, and this is why something like the Israel-Hamas conflict caused a little bit of jitters in the market, is because it wasn't really expected. Even Israel did not, they weren't ready for that initial bit of the conflict. So that causes more concerns than something that's completely expected. And I'll give you a good example. But if all of a sudden peace broke out in Russia, Ukraine, that would be unexpected good news. And no doubt world markets would go up. Doesn't feel likely at the moment. That's why it would cause that. Not to say that's everything's always possible. Now I'm going to just do this slide, which I do every month, in 2 bits. This shows the last 20 years, and it shows that downturns are normal. So we've seen the market. This is always the last 20 years. So it shows returns going back now to October 2023. Or the market for the ASX 200, which is the Australian shares, going up, but climbing the wall of worry. So going up, and we've seen FOMO, so a boom, 2005 through 2007, then the bust, fear, the absolute fear, recovery from there, and then climbing up that wall of worry. but with other worries. Now, when I show it without the labels, if I survey people and say, do you remember what caused the market to drop 17% in 2012, or 17% again in 2017, or 12% in 2019? No one gets it. No one gets it at all, because we forget. What happens is we get these little worries and they create these valleys, and then we get through that valley of worry and we forget about it. And then it climbs the next mountain. Then we create another valley of worries, occasionally the bigger ones, COVID. Right now we're in a valley, and that valley, and I'll put the labels back in. So right now we're still in that valley of the fear of inflation. Now, eventually this too shall pass, like they all do. So that one, by the way, in 2017 was fear of slow growth and falling oil prices. So right now we've got fear of inflation, growth higher than expected, oil prices higher than expected, the exact opposite, and the market's down. So the market's a funny beast. For those that think it's perfectly logical, and it's logical, but it's also complex. And any new fears tend to cause a little bit of uncertainty. And then as we work through it, it's back up onto the next mountain. Then we create another valley with the next fear to emerge. And they just roll through, with the only ones that we worry about in the long term are the bigger ones that are caused by the emotions, not the economic circumstances. And that's where we have a boom followed by a crash. So this is the latest, literally off the ASX website. And look how this has changed. So as you scroll down from the 16th to 27th of October here, and this is the market expectation of an interest rate increase at the next RBA board meeting. Next RBA board meeting is on Cup Day. So literally 2 weeks ago, there was 95% there was a 95% chance that there'd be no change. And this is just based on where the 30-day interbank cash market. So this isn't economist one and economist two guessing. This is where the market is. So right now, that market is higher than the current cash rate. So that's anticipating, but it's not completely higher. So it's increasing. We're assuming the next step is to 4.35. So we've gone from only a 5% chance to around about a 50% chance. It's backed off in the last couple of days, but we'll see with that. Now, it doesn't mean anything, but the pressure's on the new RBA governor, Michelle Bullock, to probably show that she's going to be tough on this. So, yeah, this is toss a coin stuff, and my predictions are no better than anyone, but I've got a funny feeling that in the next couple of months she may give it one or two more increases, just to, one, look tough, but two, to kind of kill it. If she doesn't, and that's equally possible, she will be explaining to the market that there are some, it's all data driven, it's all based on the numbers coming in. There'll be factors that she may consider short term. One of those key factors is that if we've had oil price increases, if we see that flow through to petrol price at the pump, increases in petrol prices do the same job as increases in the interest rates. In some ways, they do it more fairly because everyone pays. Rise in interest rates mainly affect the young ones with mortgages, whereas rises in petrol prices affect everyone who drives a car. So some people might argue that's a better way to do it, but of course they have no control over that. That's the Reserve Bank. So she may, if she doesn't increase interest rates, it'll probably be because other things are at play that will probably lead to a slowdown. But it's going to be interesting to see, and the jury's out 50-50. Yield curve, so interest rate data, and where's the new normal? It's quite amazing that we're at 4.8% 10-year bond yields. Quite amazing. Much of the market was expecting it would settle in the high threes and that 4% might be considered high, but it's broken through in that last month, as we talked about last month. Initially because of comments by the Federal Reserve that they might have to be tougher for longer. A lot of this is talk, by the way, known as jawboning. So when the authorities talk tough, it has an impact on the market, which we've seen. And that can do the job for it as well, because all of a sudden market rates can go up. That can slow down the economy. But you'll see on the top here, the yield curve. And keep in mind, the yield curve is just the interest rates from the cash rate all the way through to 30-year government bonds. And you'll see that the blue lines on those top two charts is where the market is right now. And the orange dotted line is where it was 6 months ago. and the green dotted line is where it was 1 month ago. So in the last 6 months, we're up quite dramatically, well over 1% across the whole curve. And that's this perception that, oh, maybe the battle's not over yet. Time will tell. It can fall sometimes just as quick as it goes up, and it will only take some unexpectedly good news or some deflationary patterns to start to emerge. But time will tell. So all of this in context of our wall of worry, which I've talked about, and we are quite clearly in the wall of worry at the moment. As I said, we've knocked the dial back to 6. We don't think there's much chance of big downturns. There's always a possibility, like COVID, that something black swan event occurs that drops a market by more than 20%. But apart from COVID, in the last 120 years, the only drops of more than 20% have come after booms. And that would be where we're in FOMO, where the market has doubled in the last 2 to 5 years. At the moment, the Aussie market's taken 9 to 10 years to have doubled, which is on its long-term averages. So we consider that in the cheap to fair range. So good times to be buying, definitely not good times to be selling. Single issue obsession, I've kept it on this one because we're just so focused on interest rates and inflation news at the moment. There are other political news, but in terms of what the market's looking at, that's its obsession at the moment. I've kept behavioural bias, the overconfidence bias in here, but I saw some numbers that I wanted to introduce to this. So this is about how the fact that we think we think we're better than we are, particularly on things like predicting the future. And over precision was one of those 3 types. And have a look at this in the next slide. So this is a chart of professional forecasters in the US, where they thought GDP growth, inflation, unemployment rate, and 10-year bonds were going to be at the end of 2023. We're in October. So right now, we can see that the bond rate is, I'm starting on the right here, 4.8%. They predicted 3.8. Even the average of the top 10 people only had it as far as 4.3. So none of them predicted, well, none of them in that 90% range predicted as high as it's gone. Not one professional forecaster. Let that sink in. You should never rely on these long-term professional forecasts. That's why we invest and structure our finances based on long-term plans and principles, not on short-term economic movements. Unemployment rate, the lowest that the bottom 10 people predicted was 3.9%. It's actually below that, 3.8%. So both unemployment rates and 10-year treasury yields outside the range. CPI is just above the average of the bottom at 3.7. The consensus was 4. So it's in the US, it's just below that. So that's their best one, even though it's out. But look at real GDP growth. The US is actually growing pretty strongly at the moment, above what it thought. Now, once again, you normally think that's good news, but it's bad news in terms of the inflation interest rate conundrum. So no one even remotely close to there. And if you look at the next line, the historical accuracy of forecasters on all 4 of those is less than 50%. That means you could have tossed a coin at the start of every year and had just as much chance as predicting, as the top forecasters, which is interesting. Now, forecasting is important. Not everyone, but the people in power need to do it. But they're constantly changing their forecasts as the news changes. So none of these people's forecasts would still be where it is, but this was what they forecast at the start of the year. And by the way, their forecasts tend to move more towards the actuals all the time. So that's our behavioural bias for this month. I'm not going to go through the care process this month. We'll get on with the numbers. And you'll see, we'll focus on the top right-hand chart, but negative month. 1-year returns are still okay at the end of September, but you can see here in the top right-hand chart, the crosshair is where the market finished at the end of September. It was 7,048, but we're now down to about just over 6,800, or around 6,800. So as I said, October is going to be a negative month as well, unless there's a rebound in the next 48 hours, which doesn't look likely at the moment. So, and once again, we're at the bottom of the range. We're back to where we started for the year. So it makes it pretty boring. Keep in mind, in the Aussie market, we've received a 5% dividend. So that's kind of where returns will probably settle to the end of October. US shares through VTS. Once again, we're cruising along nicely for the year. US shares to the end of September up 16%, down a little bit. Now, the reason they're only down a little bit, US shares are also down, but the Aussie dollar's down as well. And I love this, the fact that when the world has a bit of turmoil, our international shares don't go down by as much because the Aussie dollar tends to come down as well. And watch this space. I'll do another article on that in the coming months. But yeah, it provides a cushion for the portfolios. Global leaders also dominated by large US stocks, those big tech stocks like Apple, Microsoft, Amazon, Nvidia. 25% for the year to the end of September, but down a little bit in October so far, but not before they went up and then have come down, but only a little bit. Once again, the Aussie dollar has helped, plus the news from those companies still not too bad. Small caps look more like the Australian market, 11% for the year, but down since the end of September as well. So, and emerging markets, slowly coming back. Their year's actually been better, 7%, and in the month of September actually went up 2.48%, but have gone down since that as well. Gold, we had gold had risen for the month of September, but it's gone up dramatically, as gold does on geopolitical conflict. So as the fear of interest rates going a bit higher, plus the Israel-Hamas war, gold's jumped up, and which is always what we like to see. It's why we have it in the portfolio. Let's have a look at the property cycle, and from CoreLogic, who provide most of the figures that we look at in Australia. I'm not going to look at the daily change, but quarterly, everything's up different amounts, and the change year on year, about 10% in Perth. Lowest was Melbourne, 2.6%. But the property market has been remarkably resilient. Another couple of interest rate increases might see it wobble a little, but the supply and demand is so tight, I don't think we're going to see major downturns, even if interest rates go up a little more. To put that in some different ways, this shows the week, the month. Week's always too fine a bit for me to concentrate on, but September, a positive month across the board, 1% plus or minus a little in each of the capital cities, those 12 months, and the year to date. So since the start of the year, markets are up. Sydney's up 10%. Once again, I don't think there was a forecaster anywhere that would have predicted at the start of the year that Sydney property prices would be up 10%. So yeah, once again, principles and planning, best way to do long-term investing. Interest rates from those remarkable lows that we'll never see again. And there are still people out there with fixed rates at 2%. I happen to be one of those. On one of my investment properties where we were fixed 2% till the end of 24. So it's still got time to go. So this is this cliff. So we've still got people coming off fixed rates over the next year, and they're coming off 2% rates or thereabouts straight into 6% rates. So it's going to hurt the maths of their property. The average variable rate at the moment is 6.62%. You should be doing better than that. If you've got a mortgage, you should be closer to 6. You can be slightly under 6 for your home loans, slightly over 6 for your property loan, investment property loans. But if you're at those averages or worse, you should be talking to us or a good mortgage broker. And if you don't have one, we can introduce you to one, because 0.5% on a $800,000 loan, is $4,000 a year. That's a lot of money. It's worth saving. We can see the fixed rates are all converged at the moment in that sort of 6.2 to 6.4 range, 6.3 on average. Doesn't matter whether you're fixing for 1 year, 2 year, 3 year, 4 year, 5. It's about the same. Personally, I don't think it's a great time to be fixing, because there's a chance, there's no real difference. You're actually fixing slightly under where the average rates are. You're not getting any great benefit. There's always a reason to fix for those that just want to lock in their cash flow and be certain about it. But the predictive power, you would think rates have peaked. You would think they might go down, but once again, you can't bank on any of that. So yeah, as always, make your decisions based on your personal circumstances. Home loan volumes just keep going up, so it's interesting. There's still plenty of activity, and the chart on the left here shows, the red, which is investor the orange investor, the blue owner refinancing, the green owner all housing, and the red, sorry, is investor refinancing. So plenty of lending. Now, keep in mind, the average new loan keeps going up, but that's partly because the average house price is going up. So people have to borrow more to buy the increasing prices. And it's pretty healthy mix of investors and owners. And it's pretty proportional across the states, as you would expect, with New South Wales and Victoria leading the charge just based on population. So at the moment, those volumes are pretty much as you would expect and fairly healthy. So you can see that 16.6 billion of finance was done in August. That's a healthy amount of both refinancing and new lending that tells you the economy is doing all right. We've split our performance, our property clock from our friends at Performance Property into the two bits which they do it at, which is units and houses. Houses on the left here, a few changes there, but not too much, and units on the right. And you'll note a couple of things. Firstly, in the housing clock, there's a lot more blue, which is their blue chip, AAA, which they believe will grow more consistently over time. There's less of those. Well, there's none of those at the moment in the clock, and that's partly because of their belief, shared by many, including me for the most part, that houses will tend to do better in the long run, mostly because of the land content. But there are some places, and you take waterfront units, or you take really expensive suburbs where the only way in is through units for most people. But yeah, so houses aren't necessarily better than units. And you'll see at the moment, there's a cluster of places, much of Australia, where it's still valuable to buy and buy momentum. Because what we saw in the post-COVID period was house prices go up a lot, but unit prices not much. So they're in a catch-up phase now where people that can't afford houses are buying units, and that tends to bring up the value of units. So we're seeing plenty of value in places like Brisbane for units, and still places like Perth and even Melbourne, where there's good value in units, particularly as places like Melbourne will cop the brunt of the immigration increases. The pattern in Australia for immigration is most of the new immigration comes into Melbourne and Sydney, and then it slowly disperses out around the country. So a lot of pressure on property prices. You've heard everyone talk about the housing crisis. And yeah, so as an investor, that crisis is good. And I don't want to sound non-caring about people that are having trouble getting properties, but as investors, it's good. And the market will solve it. As always, it's going to take a while on this one to fill that up, but we're seeing more and more clients talking about adding granny flats or tiny homes to their properties, and that is all the things that the market will do in response. All of a sudden, a tiny home on a property can generate rent of $400 a week, and it might cost someone $150,000 to $200,000 to put on there. They're just rough numbers, so a half decent return. I'm not saying you should do it. As always, on any property decisions, talk to us. But yeah, there's lots of things going on at the moment. That's it. Short episode this one. Yeah, we're stuck in a groove at the moment. This groove will pass shortly, hopefully, as we start to get better news. But back to principles, yeah, and that is that all investing best done as a part of a real plan. Goals first, based on what's important to you. A portfolio designed to meet those goals with a long-term view, and yeah, then we focus on the boring things that create long-term wealth in portfolios: diversification, asset allocation, liquidity, and low-cost index for most markets, and protecting against that inevitable short-term volatility, like we're seeing at the moment, by these things: having enough reserves for our retired clients, so they never have to sell good assets at a bad time. Dollar cost averaging for our clients that are still growing their wealth. So right now they're happily buying away at these prices. They're buying shares on special. Rebalancing regularly, which we do for all clients within all the portfolios. And remembering there's only 3 ways to lose money and not to do them. First is panic and selling. Second is having to sell. And the third is not properly diversified. That's it for this month. I look forward to talking again soon. Yeah, have a great day, and Can't believe we're in the lead up to Christmas. By the time I talk to you again, we'll definitely be in the countdown to Christmas. And yeah, Rob McGregor signing out.